Good morning, options traders, and happy Friday once again, everyone. Recently, we've had people asking about this concept of rolling a call being the same thing as buying puts. And I've talked about that in many posts and discussions and videos, and it still leaves traders puzzled. And the whole idea is that when the market is rising, you can roll your call options. And then when it falls, you can take that cash and invest at the bottom. But notice that you're doing two things that are known. When the market is rising, we can all see that. We didn't have to predict it. And we know to roll. And then when the market falls and maybe bounces off of support, we can see that it's a known. But if you're going to just take shots in the dark of buying puts, hoping that the market falls, it's not the same thing. So again, that was really the basis of the discussions and why people were saying, how can these two things be the same? Well, one of the most important things you can learn as an options trader is that calls are puts and puts are calls. And I've talked about that in previous videos. And anything you can do with a call, you can do with a put. So if you keep that in mind, it shouldn't come as a surprise that doing something with a call, such as rolling it, might be the same thing as doing something with a put, such as buying it. You see, when you're dealing with options, you can think of it as a highway. There's let's say a northbound lane and a southbound lane. And everything you can do in the northbound lane can be done in the southbound lane. They have the same exits, they have the same rules, the same speed limits. Everything is virtually identical. It's just a question of which direction you're heading. So it's the same thing with calls and puts. They are far more alike than different, and yet most traders think they are completely opposite. And that is simply not true. It just depends on the delta hedge. So again, thinking of the analogy of the highway here, if you're heading in the northbound lane and you just do a U-turn and head south, did anything really change about where you are, the exits, the speed limits, the rules? Not a single thing. It was just a change of direction. So that's a little bit of a background on why calls are puts and puts are calls. So remember, the most important thing, or certainly one of them, that you need to understand as new traders is that calls equal puts and puts equal calls. Anything that can be done with a call can be done with a put. It just depends on the delta hedge. So for example, let's say that we have a $100 call, and I think most of you know by now from my videos that we always get a bend right at the strike. So this is the 100 call, and we have positive deltas out here to the right. Looks like long shares of stock, but we have this flattened portion to the left because our call would expire worthless if the stock is below this strike at expiration. So this might be thinking of heading in the northbound lane or heading in the bullish direction. So how do we do a U-turn? All we have to do is short shares of stock. If I add short shares of stock, we have negative deltas that are combined with this zero delta portion. So take a look. Let's put a dividing line right here at the strike. The red line has negative 100 deltas, right? It's short shares of stock. What is a flat line? Well, that's zero. So if we combine minus 100 and 0, we will end up with negative 100. We're going to have negative 100 deltas, everything to the left of this dotted line. What about to the right? Well, the blue line has plus 100 deltas. It's like long shares of stock. The red line, again, negative 100, right? It's all part of the same red line, so it's got negative 100 deltas down here. So what's going to happen if we combine plus 100 and minus 100? You've got it. We've got 0 over here. So that means if we buy a $100 call and we short shares of stock, we're going to go from these two positions of blue plus red, and we are simply going to have this. We've now turned it into a $100 put. And many of you may recognize, who understand synthetics, that a call plus a short stock position is a put. And that's what's causing this to shift or to become a put option. All right, but what would happen if we had started with a put? Let's erase the slate and pretend that this is a put option, 100 strike, right there is our bend, but we have negative deltas over here to the left, like short shares, and we have 0 over here to the right, at least at expiration. So what would happen if we added long shares to this position? Let's throw in some long shares of stock. Let's put a dividing line right here at the strike. Take a look at the left. On the left-hand side, we have negative 100 deltas over here in blue. Down below, we have plus 100. Long shares of stock are always plus 100 deltas. So if we combine minus 100 and plus 100, we've got 0 over here to the left. What about on the right? On the right, we still have plus 100. Remember, that's the same green line. It's always plus 100. Down below, we have 0. Plus 100 combined with 0 gives us plus 100. So everything to the right of the strike, we should have positive 100 deltas. We should have 0 to the left. So let's do it and see. What if we bought a $100 put and then also bought shares? And if we put these into our account, this is what we would have. We've simply changed the direction with our delta hedge. So synthetically, a put plus long stock equals a call. And that's what we did. We started off with a put, we threw in some long shares of stock, and we now end up with a call. So now, keeping these points in mind, let's take a look at an example of rolling. Let's say that we buy the $100 call for 6 and we roll it to the 105 call. So you should know by now that, and if you don't, we've got videos in here on rolling, but that means you are going to sell the 100-105 vertical spread. And selling the 100-105 vertical spread means you are selling the 100 call, which is going to cancel this one out, and you're buying the 105. Which will just leave you long the 105 call. You're just swapping them out, closing this one out, replacing it with the long 105. And you will get a credit. Now, normally for stock replacement, we're going to shoot for a credit of 4. But when you do that, you are going to increase your break-even point by the balance, in this case, $1. Now, by the balance, I mean this is a $5 roll. That's the difference in strikes, for which we got a $4 credit. What's left over? 1. That's going to increase our break-even point by $1. So let's take a look. Here's our $100 call for 6. There's the maximum loss. When we roll to the 105 call, we get this. Here's our bend now at 105. So the main reason we do this is for this $4 credit. So we shift from the low point of this red to up here to the blue. It's a hedge. We're doing it to reduce the downside risk. But it doesn't come for free. Notice that the red line out here sits above the blue. If we didn't roll, we would be more profitable if the stock runs, but we don't know that. That's the reason that we're doing this. So do you see how the red line has shifted to the right, to the blue? And that's that little balance right there, that little white slice in there is $1. So by rolling, we've taken in a $4 credit in exchange for increasing the break-even by $1. But notice we could do exactly the same thing if we bought the 105 put for $1. Okay, if the stock is way out here, sufficiently high so I can roll from the 100 to the 105 for a $4 credit, that put will be cheap. And mathematically, it will be trading for $1. So if I bought the 105 put for $1, I have increased my break-even point by $1, the amount that I've spent, but I've boxed in 5. And that's because I now have the right to buy shares for 100 with the 100 call, and I have the right to sell for 105 with the 105 put. So that's a $5 guaranteed gain for which I've paid $1, and therefore it gives me a net gain of 4. So rolling the call from 100 to 105 is exactly the same thing as keeping the call, but buying the 105 put. So that's why when you're rolling your call options, you are mathematically buying puts. Too many times traders get near what they think is a market top and they say, well, maybe I should sell my calls and buy puts. That's taking a shot in the dark. It's a bad idea. Roll your calls, just bank the cash, keep it on the side, knowing that it's going to come back to you for future use. When we get the market pullbacks, you will know it. You won't be guessing. And at that point, you can take that cash and reinvest it at the bottom. And so that's going to make things a whole lot easier than just taking shots in the dark. So I hope that helps to explain it. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatozee.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find the link in the description below.